Welcome everyone. Today my session about the cash flow forecasting. The cash flow forecasting means we are talking about the cash flow and forecasting. Cash is important, right? It's very important for a business organization. We call it like a blood for a human. So we are talking about today the cash flow forecasting, right? If you know that thing, normally always a business organization they are using some cash, currency. It can be dollars, it can be rupees, it can be pound, yen. So we are going to find out understand the importance of a cash flow for a business organization first of all, and we are going to find out the difference between cash and profit, and we are going to find out the interpretation of the cash flow forecast, the preparation and interpretation part. We are not going like that much of like hard questions in cash flow like accounting, but here we are going to find out interpret the cash flow forecasting, the cash flow forecast in the business organization. So you can see we normally business organization at the end of we're talking about the public limited companies, private limited companies. At the end of their financial period, they are preparing cash flow statement. Cash flow statement is different from a cash flow forecast. That's what first of all you have to find out. Cash flow there's a cash flow. Normally it's a part of the financial statement. Cash flow statement. Forecast is not a part of the financial statement. So I'll show you. I download some actually financial statement from the Colombo Stock Exchange. You can see this is Abans Electricals, Abans company, well reputed company in Sri Lanka, doing electricals and everything. So this is their cash flow statement. So cash flow statement, they are showing the all the cash inflows and outflows of business organization. You can see here, this organization, they have given the cash coming from the operating activities before working capital changes, and net cash flow, investment activities, cash flows coming from the main investment activities, cash inflows and cash outflows. Like interest income is inflow. Within bracket we can see purchase of property, plant and equipment and intangible asset is a cash outflow. Like that, there are inflows and outflows. Cash inflow means money coming inside the business, like interest income. It can be the other one, the cash flow coming from the financing activities. Financing activities also we have cash inflows and cash outflows. So here you can see with the bracketed figures mean is cash outflows, money going out of the business, and positive figures indicate cash inflows, right? So you can see financing activities, they pay dividend for their shareholders. The last years you can see 15 million and 7 million. You can see this cash outflows. But during the year they receipt from loan, receipt of loan from like a loan, they taken some kind of bank loans, 30 million. You can see that is cash inflow. So if they have getting money inside the business, that is inflow, and if you're paying something, that's cash outflow. You can see repayment of loan outflow 35 million. Repayment of the leasing liabilities, you can see 19 million. Like that, there are different headings: investment activities, financing activities, operation activities. Like that is a cash flow statement. So we are not going to actually like prepare this thing. We are going to interpret the cash inflows and outflows of business organization. Therefore, the business organization are always responsible to actually find out the cash inflows and outflows. So at the end of the cash flow statement, you can see we are finding out the cash balance, ending cash balance. You can see cash and cash at bank, cash in hand, bank overdraft, cash and cash equivalents at the end of the year. So this is every business organization. You can see in the listed company or private limited company, we can find out this kind of a cash flow statement. But our today's lesson is about cash flow forecasting. Cash flow forecasting. Cash flow forecasting and cash flow statement means actually two different things. Right? Trying to find out the difference. This is a statement which is actual values going, coming and going, and this is just a forecast. Forecast means we are predicting, right? We are predicting the future cash inflows and outflows for a business organization. So this month we have to pay this much of wages, right? For example, this is month of September. You can see October we are predicting that we have to pay this much of electricity bill. So you can plan your future. This is a kind of a planning, financial planning. This is part of the business plan. And managers only like normally they're preparing like a daily basis. They're preparing the cash flow forecasting they're doing, because future cash inflows and outflows they have to predict. They have to know, because otherwise you can't run your business. It's like you must have some plan before you execute the business. Before you're implementing some decisions, you should know whether do we have enough sufficient cash inflows and outflows. Because otherwise, if you don't know the cash flow forecast, the danger of if you're not preparing the cash flow forecast means that you don't know. Sometimes you might have some kind of a cash flow difficulties. Shortages can become. Sometimes that means you don't have a plan. This is really important financial management principle, cash flow management or cash flow forecasting. So today you're going to learn a very important lesson, the cash flow forecasting. This will be not for only examination purpose. You can even personally also in future, whatever the profession you do, whatever the job you do, cash flow forecasting is individual level as well as business level. It's really important principle. It's really important knowledge base. So therefore, let's talk about the cash flow forecasting. There are plenty of possible questions as well. So I hope to actually discuss the relevant possible question at relevant places after finishing. You can see cash flow main definition. We can see it's a flow of money into and out of a business. Flow of money coming in and going out into and out of a business. In the cash flow forecasting, normally you can see they are giving getting started. I think the flow of money into and out of a business is called the cash flow. Money coming and going. But the problem is we have to analyze, we have to predict, we have to know how much coming, how much is going. We should have some control over it. Otherwise, you don't know. Sometimes business can fail. But the thing is, sometimes even cash flow forecast also has some limitations, right? Sometimes we can't actually 100% accurately, we cannot predict our incomes and expenses. But it doesn't matter because we have something that is 80%, 90% accurate, not 100%, right? Sometimes external influences, external like a global pandemics, this kind of economic shocks, we cannot predict in advance, but we can predict some kind of like a general about 80% of the expenses and income. We cannot 100% we can accurately predict, right? So cash flow is a kind of a money into and out of a business cash flow statement, and cash flow out of a business when payments are made of resources such as materials and labor. So we have to pay for those things always: material, labor, overheads, insurance, electricity, water bill, utility bills, telephone bill, everything. So cash flow into a business means when the customers pay goods and services. That's the main income. The main income for a business is the customer payments for sales. Not only that, sometimes you can get some cash flow can come from the loans, bank loans. Bank can become from bank interest. Sometimes your other income, rent income, like that. So this is the cash flow forecasting. So cash flows in other income as received, for example, such as interest income. Okay, look at this example. After that, we'll talk about that. Aga Brick Making, right? Okay, I invite Samara. Can you read the case study, please?
Hayden and Thomas Aga run a small brick manufacturing business near Mombasa, Kenya. They set up in 2012 when it was apparent that the real estate market in the country was growing rapidly. Hiren went on a brick making training course and then bought a brick making machine with some financial help from his brother Thomas. In June 2016, the business received 155,000 cash from customers. Also in that same month, the business paid 43,000 for raw materials, 20,000 for rent, 12,000 for fuel, and 11,000 for other expenses. Hiren and Aga also took out 20,000 each for their own personal use.
Okay, thank you. So you can see this is a small example of the Kenyan case study. They are brick manufacturing. So, and after they set up the business in 2012, they have some kind of income and expenses. You can see in the second paragraph. This KE stands for Kenyan shilling, their currency. 155,000 cash inflow from customer, and 43,000 for raw materials, 20,000 for rent outflow, 12,000 for fuel, and 11,000 for other everything outflows. Right? Only inflow you can see is 155,000 received from customers. Now asking 3 questions. Suggest ways in which cash flowing into and out of the business, bricklaying business. Example, suggest the ways in which cash is flowing into and out of the business. If you go through this thing, you can see normally every business organization, the main money coming in is actually from customers. In this case study also, we can see the answer. The cash flowing into the business from customers. That is 155,000 KES flowed into the business in June 16. In the same month, cash flow out of the business, examples like 43,000 raw materials, like that, all the examples they have given, 20,000 for rent and everything. So everything you can see, this is cash inflows and outflows. And second question they're asking, work out the net cash flow. Net cash flow. Net cash flow definition here, I'll separately do it, but net cash flow equal cash inflow minus cash outflow. Then we call it net cash flow. So here the answer is 155,000 minus all the expenses, right? So that is equal to 126,000. That is a net cash flow become 29,000. 29,000. So 155,000 minus 43,000 plus 20,000 plus 12,000, then plus 11,000 plus 2 times 20,000. So we have to find out why 2 times 20,000. You can see, go to the case study. There are some terms and conditions are same. You can see, for example, there are 20,000 for each of their, so there are two people are working, Hiran and Thomas. Therefore, for each 20,000 into 2. So for their own expense, personal expenses also, they have taken some money. That 20,000 into 2 means like that, so you multiply by 2. So after multiplying by 2, you can see total expenses become 126,000. So net cash flow is 155,000 minus 126,000, that is 29,000 Kenyan shilling. So this question 2, the answer shows the net cash flow. There was a positive net cash flow of 29,000. Positive net cash flow. So that doesn't mean this is not their profit. There's a difference between profit and the cash. I'll tell that also. This is not the profit. This is what we call net cash flow. Net cash flow, right? So now we can see, now we're going to important topic, the importance of cash. The importance of cash. You know, when you're doing business, as I told you, the business, the liquidity is really important. The business liquidity means that how much the ability to pay the expenses for you. So cash is the most liquid for all the business organizations, like liquid asset in a business, 100% liquid asset. If you name the 100% liquid asset in the organization, that is cash, right? Because you don't need to convert that into money again, because it's already money. So cash is notes and coins a business keeps on the premises and any money it has in the bank. So without cash, business cannot trade. It's true, no? Right? It is reckoned that the poor cash flow is the reason why many business eventually fail, right? If you talk about the reasons for business failure, this is coming number 1, right? Why business fail? Poor cash flow. That is the business running out of cash. The main reason for business failure, at least about 90% of the business failure, I can see like percentage wise, 90%, the main reason for business failure is running out of cash, a poor cash flow. Therefore, this lesson is really important, right? If you have an idea to start a business, or if you have already business, if you're running, so the important thing is the cash flow is the most important thing. If you have the poor cash flow management, means that's the main reason for business failure. Then you have to take a loan and the financial burden comes after that. And then like a lot of payables are then coming, then business will eventually bankrupt. When the trading conditions are good, business can even fail without cash. Even if a business does not have enough cash to pay its immediate bills, it cannot trade. So what are the immediate bills mean? Immediate bills mean your utility bills. You have electricity, water, telephone, right? Immediate bills, because without paying telephone bill, you cannot use. It will be automatically disconnected. Same thing for the others as well. So normally immediate bills must be able to pay, so it cannot trade. Business need cash for the following reasons. We'll see what are the reasons business need money. There are so many reasons, but here we are going mainly major 2 reasons: to pay suppliers, overheads, and employees. To pay their suppliers, overheads, and employees. That's the first point. You know, everything I think we talk about the outflows. Supplier payments is important, crucial, because when you're doing buying and selling business, you have to pay your suppliers on time regularly. Overheads mean all the expenses that you are paying, like electricity, insurance, rent, advertising, water bills, everything comes under overhead. And employees, they have to pay salaries and wages, payroll they have to maintain. So these things are important, mandatory. So business to business, it will be depend. So in given case studies, you have to find out the importance. The different expenses are different. For example, I'll show some past paper question. You can find out in different case studies, you have to identify different type of expenses. But these are common, like paying suppliers, overheads, paying employees is a common expense. As you can see, Overhead definition is here, right? Because sometimes if you don't have idea what is overhead, if you're accounting student, I know you can understand what is overhead means. Overhead means money spent regularly on like rent, insurance, electricity, and other things that are needed to keep a business operating. So this is important. Sometimes, perhaps sometime you can get 30 to 90 days time period to pay your suppliers. Sometimes this is called working capital management. Immediately you need to settle suppliers. Sometimes they are giving some grace period. Buy now, pay later. Okay, I'll give you 3 months. You can buy this amount, you can purchase it and you can sell, but within 3 months, deposit my amount. Like that. So these are the main example of the every month you're doing like a recurring nature. For example, electricity bill, recurring nature. Every month you have to pay. Water bill, every month you have to pay monthly wise, right? Employees also salaries, you have to every month you have to pay their salaries and wages, your payroll. And other thing is to prevent business failure. To prevent business failure. Prevent business failure means, the business run out of cash, it become insolvent. This word very important, understand. Insolvent means inability to meet their debts. Another term we call is a bankruptcy, right? Sometimes we call, this is called sometimes, we are going to like, inability to pay our debts. Customers are there, but there are so many debts to pay. Sometimes the cash flow is not enough. So this case we call inability to pay. This case you have become insolvent. This means that the business cannot pay their debts. It would usually result business closing down, and this is the worst that can happen, closing down a business, right? So a lot of business we can see these days because of the pandemic cases. A lot of business actually has to close, especially like a hotel field. If you talk about the other restaurant industry, and so many, I'm talking like so many industries, if you see that they are closed down because of the inability to meet their payments. No customers, no sales, business has locked down for a couple of weeks, couple of months, then no income. Then how can they pay their electricity bill? How can they pay their rent? How can they pay their suppliers? So business has finding a lot of cash flow difficulties, problems. So if they cannot actually pay everything, so they becomes best thing is to shut down, because there is some tolerance level for all business organizations to keep like that. So if you have to shut down the business for a period of time, sometimes this can be temporarily, you can shut down, sometimes permanently. So you can see some organization. I'll give a very famous example recently, the Sri Lankan case study. You can see a lot of businesses and international case study. For example, Thomas Cook. Thomas Cook actually went in 2019, right? They actually bought by Chinese business called fore. Thomas Cook was 178 years old business, but eventually gone bankrupt, insolvent because of these cash flow problems. Because a lot of that's a different story, right? Like that, so many organizations are right now in the situation of the business failures. So because of the running out of cash, that's why unless a business can raise cash immediately to pay for the most pressing debt, the business will collapse. Therefore, it is important that all business continually monitor and control its cash flow. The business will have better control over its cash flow if it keep up-to-date record of financial transaction, and always plan ahead by producing accurate cash flow forecast, and operate an efficient credit control system which prevents the slow or late payment. So that means definitely you have to accurately, up to date, you have to maintain your records. Secondly, you have to plan ahead, accurately cash flow forecast, you have to plan ahead. Planning is important, forecasting is important. Sometimes we call, like if you fail to plan, that means you plan to fail, right? That's the main important. So you must plan your expenses, plan ahead, right? Your expenses, your incomes, you have to plan, right? So these are the main important things. So this is the imports of cash flow section. I would like to show some kind of past paper questions right now. If you go to my handout, you can see in the page number, last page, go to the last page of the handout, you can see that's asking question number, this one, 2020 November, very recent paper, 2020 November, they're asking, analyze the imports of cash to TADS. 6-mark question came from this section that we discussed. They're asking, analyze the importance of cash to TADS. TADS is a drumming school, right? It's a drumming school, DS drumming school. They're asking importance of cash. For drumming school, what are the expenses? You can see, yes, this is the answer. You can see 2 mark, 3 mark for the AO2 application and 3 mark for the analysis. So you have to identify 2 applications which is relevant to the drumming school. For example, if TADS has a sufficient cash, it can pay its electricity bills for the music studio. Music studio, there are electricity. If you just say electricity bill, no marks because it's not, it's a generic answer. You have to say electricity bill for the music studio. And look at the analysis point, how it will be important. If TADS cannot afford to pay their bills, then the electricity would be cut and no lessons could take place, right? That's the consequences of inability to pay electricity bill. That's called analysis point. Analysis means always write some consequence, causes and effects of that, right? So first one is a cause, the electricity bill you have to pay, right? So sufficient cash is important to pay the electricity bill. In case they cannot pay the electricity bills, then studio has to be closed, right? Like that. So second point you can see, because you have to write a second point, the second paragraph. If TADS run out of cash, it means it cannot pay the music teachers. So you are mentioning their salaries and wages. You have to say it can't pay their music teachers. That's application. Since it's a drumming school, right? So if you just say it cannot pay, cash flow is important for them to pay the salaries and wages, no marks. That is salaries and wages of music teachers. Don't say the word employees, say music teachers. That is application. And then look at the analysis point of that. So if TADS can no longer pay its teachers, it cannot offer any music lessons. The consequence of that, if you cannot pay the salaries for the music teachers, then they can no longer, right, cannot offer any music lessons. So like that, this is how you have to simply, it's all about the main important point in knowledge points here. You can see here, electricity bill payment, salaries. Cash flow is important to pay the electricity and salaries. All comes under overhead. But look at the way they provide the present answer. That's based 100% based on the context. That's why in business, that is always the contextualized answer is the main thing, right? You can study the example. For example, now we just learn about what is importance of cash flow. In the textbook, it refer, okay, business need cash flow to pay their suppliers, overheads, and employees to prevent business failures, right? You can study the important thing, but you must have to have some kind of a knowledge to apply this thing to the different scenarios, different contexts. Example 2020, it was a drumming school. So you have to say they need to pay the electricity bill for the drumming studio. They have to pay the salaries and wages to their drumming, the teachers, music teachers. Without saying employees, you have to be able to, like, if it's an airline, you have to say they need money to pay their pilots and crew members, right? Like that, everything, whatever the case study, must be able to apply your knowledge to the relevant wording to the given case study. That's a talent. That's a important skill that we need in order to get a high marks in the business studies, at economics and all subject like that. Application is really important like that way. Okay, you can see this is very highly example. So this, out of this case, you can see what is importance of cash. They asked this situation in 2020 paper. And we are going ahead. You can see the difference between cash and profit. That's another important topic. What's the difference between cash and profit? Normally, I told you net cash flow is not equal to net profit. That's two different meanings. Here we can see the cash and profit. When I calculate the cash, normally you're taking all cash inflows and outflows. Here you can see this company simply. They're taking all the cash inflows and outflows. Cash inflows and outflows coming from operation activities, investment activities, and financing activities. But they are taking the cash basis, not the accrual basis. The main difference between the cash and profit here, the cash flow normally are taking the cash basis, right? That whatever the item we actually received and paid. But in profit and loss account, income statement, we are taking the accrual basis. I think the accounting student, if you have some kind of sort of accounting knowledge, you can understand what is accrual basis and what is cash basis, right? Accrual basis is always we are considering the whole period, whatever we paid or not, any expenses, if you received or not any income, they are taking the whole 12 months period, accounting period into consideration when you are taking our numbers. That's accrual concept. That's why we all have prepaid expenses, accrued expenses, accrued incomes are coming. But in cash flow, we are not taking the accrual concept, we are taking the cash basis, just how much actually we received or paid in cash. And in cash flow forecast, we don't have any other non-cash expenses, for example, such as depreciation. If you know that in income statement, we deduct some expenses called depreciation. Account student might be know the depreciation like straight line method, reducing balance method. We depreciate the fixed asset, property, plant, and equipments. But that's a non-cash expense because depreciation expense is not actual cash outflow. It will be remaining in the business in reserves in accumulated depreciation account. But actually, it is not a cash outflow. So in cash flow forecast, we are not adding that non-cash elements like depreciation. Okay, so I would ask Devane, can you read that first 4 points?
Yes, sure, sir.
Yeah.
Some goods are sold on credit, trade payables. So at the end of the period, some customers will still owe money. Therefore, profit is greater than cash. Similarly, a business may receive cash at the beginning of the trading period from credit sales made in the previous period. This would increase the cash balance but not affect profit. Sometimes owners might put more cash into business. This will increase the cash balance but have no effect on the profit made. The effect will be the same if a business borrows some money. Purchases of fixed assets such as machinery or equipment will reduce the cash balance but have no effect on the profit the company makes. This is because the purchase of assets is not included for the purpose of calculating profit. The amount of cash at the end of the period will be different from profit because at the beginning of the year, the cash balance is unlikely to be zero.
Okay, thank you. Very good. So mainly there are 4 reasons they are giving. First one, credit sales and trade payables. Like, normally business doing transaction on cash basis and on credit. But normally if you purchase some item or sold some item on credit basis, it's not affected to our cash, but it affected to our profit. So that's another one reason they are giving the credit basis sales, trade payables, trade receivables thing. It is impacted to a profit. It's included in the profit. Credit sales are there in the revenue section, but credit sales, there is no cash impact for the cash flow. And secondly, the owners in other investment, owner might put some more money into the business. We call owners additional capital. Additional capital coming to the business is a cash flow, cash inflow, but additional capital is not impact on the income statement because it goes to the SOFP. They add into the capital only. Cash will increase, cash will debit, capital will credit. So therefore, there is no impact on the income statement. Because of that, there is no impact on profit from additional capital. And third one is there is no impact on profit from purchase of fixed assets. Right? Purchase of fixed assets is only just a cash outflow. Right? Cash flow going out, cash account credit, asset account debit. So it will reduce the cash balance, but there is no impact on the profit or loss. Right? And the last one, they say the amount of cash at the end of the period cannot be zero, which means there's an opening balance is there always in the cash, but there is no opening profit in the income statement because profit is normally is a annual concept, but cash balance is normally is a flow concept. You can see always the opening balance mean the previous month closing balance. So January opening balance means 1st of January opening balance means 31st December closing balance is always brought forward. Cash balance will be brought down for the next period, next month. But profit is not like that. So these are the main 4 reasons. And this section, the difference between cash and profit, not that much tested in our exam so far. But you should know in case they ask what are the explain one reason between one difference between cash and profit. You must know at least one example should keep in your mind to write down the difference between cash and profit. Okay, now I'll show you kind of like a pass up question right now, like from all papers and the new paper. This is the cash flow forecast question came in 2012 paper. You can see the cash flow forecast here. You can see the 2012 paper, EC Limited, and they are providing the cash flow forecast. You can see month of July, August, September, October, November, December. And they're asking 1 mark question, calculate the net cash flow for the August. So I told you the net cash flow already is a cash inflow minus cash outflow. The August month, you can see this is August, here we go. Here's a question mark is there. They haven't given the net cash flow figure. Right. Okay, you can use any calculation. You can see now closing balance we can see, and we have to find the net cash flow. So net cash flow definition, I'll again tell you, net cash flow equal cash inflow minus cash outflow. So you can see mainly cash inflows are here 26,000 pounds, cash outflow is 30,000 pounds. So then definitely here value is how much? Yes, minus 4,000 pounds. When you write in this answer, you can say it's minus 4,000 pounds, minus 4,000 pounds. And look at the other question, asking you 2 examples of cash outflow, right? You have to understand that what are the examples of cash outflow. Because this is a question, the case study was EC Limited, is called Erin's Chocolate. So chocolate manufacturing small business. What are the cash outflow here? Yes, Samara, you can answer. Yes, Samara, you have a question? Yeah.
No, so that was from before.
Yeah. So mainly, net cash flow is easy calculation. You can see 26 minus 30 means it's a minus 4. It's minus 4,000. So answer in your writing here, you can see minus 4,000. And cash example, cash outflows, you can see. So it can be electricity bill for the factory. And you can see mainly the suppliers, payment of suppliers for the cocoa. You must write some examples and the contextualized example. You just can't write electricity and supplier payments, everything. You have to say, okay, suppliers of cocoa, because a chocolate company, you have to say chocolate main ingredients are this is sugar, cocoa, butter, like that. So you can mention like the payments of the suppliers of cocoa or butter or sugar. Or you can see electricity bill for the manufacturing shop, like that. So these are, we have 2 examples you have to write. Out of that, 2 mark for that. And they're asking this question. This is the, since it's 2012 paper, the command words are different. And the marking also. This question can be, we can say it's a 6-marker question to analyze. Right? This is so all papers, since the 5-marker questions are there, but normally now we can convert to a 6-marker question and change the command word as analyze. Analyze how cash flow forecast can help business such as EC Limited to make financial decisions. So this is the part now we are going to understand. We are going to do the imports of cash flow forecast. Imports of cash flow forecast. So now we have to understand what is cash inflows and outflows. Cash inflow definition is here. The flow of money into a business. The flow of money into a business we call cash inflow. A lot of examples are there. In the examples, like 155,000 received from previously from customers. That's a cash inflow. What is cash outflow? Cash outflow means money going out of the business is called cash outflow. Money going out of the business we call cash outflow, like purchasing some equipments, purchasing raw materials, paying utility bills, rent, tax. So many examples are there, right? And the net cash flow is the difference between cash inflow and the cash outflow, right? Look at this example. There are inflows are normally coming from petrol sales, repairs, car sales, miscellaneous incomes. Outflows are wages, petrol, parts, car purchases, other expenses. Okay. Now let's move on to some kind of questions. In my handout also I have mentioned some kind of a questions like this. If you go to the cash flow forecast, the tute number 29, you can see not even the past paper question. You can see here the cash flow, this picture. Understand this picture. I gave some idea in a business organization. Money can be come in like a cash flow in from investors, from our, you can see different thing from capital from the owners and the profit, right? Mainly from customers, investors, capital and profit. Different cash inflows like money coming out, like water coming out the water tank. And there are some water leakages are there, like water cash outflows, and such as wages, like expenses, like bills, overheads. So at the end, if you pay everything, there will be remaining value we call the net cash flow. So cash inflow minus outflow, that we call the net cash flow. Net cash flow. So this is the basic idea by using a small like a picture, cash inflow, outflow. And I have given the main idea. The cash flow is a movement of money into and out of the business. The cash flow inflow is the business money coming into the business. Cash outflow means like cash going out of the business. Net cash flow is the difference between money in and money out. So those are the most important definitions and everything you have to find out. And Imports of cash to business. This section I have already discussed. I'm given here, right? Even if you don't have a textbook, you can use that notes and everything to pay for your suppliers and overheads and to prevent business failure. And the explanation also given here, right? And the overheads, the liquid overhead definition, you can take an example. Overheads are the, you can see, general expenses that business has to pay regularly, right? If you write, you can write down that, note down that part. Overheads are the general expenses the business has to pay regularly, such as electricity bill, wages, right? Or insurance, advertising. You can write some examples also. General expenses. Insolvent definition is given, and cash flow forecast. So what is the cash flow forecast definition? Cash flow forecast is the money coming in and going out of the business. You can see the cash flow main definition, you can find out. Cash flow forecast is a statement that summarizes the cash money coming in and money going out of the business organization. Right? In cash flow definition is there in the textbook like that. Cash flow forecast definition. Cash flow forecast is the proper statement which actually summarizes money coming in and going out of the business. That's the cash flow forecast. So cash flow forecasting, the importance. Now we are going to find out the importance of the cash flow forecast. Here, the definition of cash flow forecast we can find out in page number 219. You can see cash flow forecast is a prediction of expected receipt and expenses of a business over future time period, which shows the expected cash balance at the end of each month, right? So if you have a textbook, you can copy down the definition from there. Otherwise, you can write down the main definition. Cash flow forecast, you can see, it's a summary of like a prediction of all expected receipt and payments, all expected receipt and expenses of a business over a future time period, which shows the expected cash balance at the end of each month. Expected cash balance at the end of each month. Right. Okay, now cash flow forecasting. Now we're going to understand how to prepare, how to actually interpret a proper cash flow forecast. In this case, you can find out in business organization, normally this is a usual typical type of the cash flow. Normally months are there, June, July, August, like that. So you can, this is only for 3 months. So, and you can see cash inflows. There's a topic called cash inflows. Cash inflows in the business comes from mainly petrol sales, repair, car sales, and miscellaneous sales. And after adding all that for income, that we call the total cash inflow. Total cash inflow is the amount of the cash the Kamal Motor Services expect to generate during the month. So in June it's 8,950, July is 9,350, and August 9,500. These are the total cash inflow. After that, we have to deduct the cash outflows. So you can find out main cash outflows are wages, petrol, parts, spare part, car purchases, and other expenses. You can see all cash outflows going as a cash outflows. These are the main headings, the bolded lines. And the difference between cash inflows and difference between total cash outflows, we call another line we call net cash flow. Net cash flow. So here the definition of net cash flow given here. This is the difference between the total cash inflow and the total cash outflow. Okay. Another important thing now, opening balance. Opening balance in June is the closing balance of May. Now the closing balance equal net cash flow plus opening balance. Here in this case, you can see net cash flow is 1,450. So 1,450 plus 450 equal how much? 1,900. And you can see like a chain, the closing balance of June becomes the opening balance of July. Again, we add them up, the net cash flow plus total net cash flow plus opening balance, that is equal to closing balance. So July closing balance 3,650, and July closing balance is the August opening balance, right? So August closing balance is the September opening balance. September closing balance is the October. It goes like that. November, December, it goes like that. So mainly you can find out, this is very important and very basic, right, formula. So net cash flow equal inflow minus outflow, and closing balance equal inflow cash net cash flow plus opening balance, like that. So you can see, if you go to the last page of my handout, there's a MCQ question also there which comes from this section. there's an MCQ question which come from this question, asking the formula to calculate this one. You can see net cash flow equal cash inflow minus outflow. There are so many activities in my handout. We can see this is the MCQ question. In 2020 November, paper 1, there's asking which one of the following is to calculate the net cash flow. Okay, I'll ask this question from Agilash. What is the correct answer for this question? Which one of the following used to calculate the net cash flow? Total cash inflow minus total cash outflow, A. Part B, total cash inflow divided by total cash outflow. Opening cash balance minus closing balance. Opening balance plus closing balance. What's the correct answer?
Sir, C.
Opening balance minus closing balance? No, that is not the
Yes,
net
it's
cash
A.
flow.
It's A.
Yeah.
It's A, right?
A, correct, very good. It's total cash inflow minus total cash out. That's called net cash flow. The answer is correct. So mainly in our today's lesson, what we discuss, we talk about the cash flow forecast. We talk about what is cash, the importance of cash we talk about. We find out that the business need money for 2 reasons mainly: to pay their suppliers, overheads, employees, and prevent business failures, with the past paper questions also. And we talk about these definitions: overhead, insolvent, cash flow forecast, and talk about the difference between cash and profit. And finally, we talk about the calculate the cash flow of a firm. So there's a small homework now. You can actually, by using this example, please fill this table. You can write down the total values. What is the cash flows? What are the cash outflows? And what is the net cash flow? And what is the opening balance? And what's the closing balance? Right? This is a summary part, summary of the headings. So I think you can fill it in your own ways as a homework question. Okay, from that, I'm winding up my today's session. So thank you very much for having this session. See you again on my next session. Thank you very much, everyone. Bye.
Thank you, sir. Bye, sir.
Thank you, sir.
Bye.
Thank you, sir. Bye, sir.